We expect a volatile year for equities and risk assets because of uncertainty from geopolitical risk. Stocks have performed strongly so far in 2019, and that could lead equity investors to de-risk their exposure and cushion their future returns. Convertibles enable investors to remain invested in equity-correlated asset class, but the bond side of convertibles mean they buffer investors when equities are performing poorly. In an environment where volatility is expected to rise, convertible bond investors would benefit due to the equity option they own as part of the bond. But they would also be protected from equity downside due to the bond element. Convertibles can diversify asset allocation in terms of region and in terms of sectors. On a regional basis, convertibles give attractive exposure to emerging markets in Asia or substitute existing exposure. That gives investors the opportunity to tap into stronger growth potential. Secondly, because the US is regionally less dominant in convertibles, investing in convertibles can diminish the exposure to the US market. In terms of sectors, convertibles tend to be less exposed to low-growth sectors and more exposed to high-growth sectors. Traditional bond issuance in credit markets predominates in low-growth sectors where companies have become increasingly leveraged since the financial crisis a decade ago. Convertible issuance, in contrast, tends to have a heavier weighting to high-growth sectors. A risk-adjusted basis takes account returns on an investment as well as the volatility along the way. Over the long term, convertible bonds have generated similar returns to equities, but have done so with a lower volatility. That means they have higher risk-adjusted returns than simply buying shares. We believe this makes convertible bonds attractive to investors in need of the growth potential of equity markets, but wanting to reduce their exposure to equity market volatility.